So in this video, I want to talk to you about why you should consider diversifying your stock portfolio into other investments, alternative investments, such as real estate. So I want to talk about, first of all, about the numbers. So the average stock market return over the last 20 years from 2004 to 2023 is about 9%. Now, if you actually invested $100,000 in the S&P 500 at the beginning of 2004, and you kind of go up with the increases and the decrease, it'd be worth about $780,000 in 20 years. Now, this represents a nominal average annual return of 10.4%, roughly 10%, okay? Which is not bad, it's not bad. But the important thing to consider is the effect of inflation, especially when evaluating long-term investments like this. So when adjusted for inflation, the real value of this investment is only about a 7.8%. That's called real growth as well. So inflation is a real thing. Normally, peters along at 2%, but as we've seen recently, it was a real doozy and has a real impact on your actual returns. Now, these returns of 8% real growth over the last 20 years is before any kind of brokerage fees. So the average expense ratio for actively managed mutual funds is between 0.5 and 1%, and they can even go as high as 2.5% or even more, especially when you have a portfolio manager. Now, for passive index funds like ETFs, the typical ratio is much lower. It's like 0.2. Now, most investors have a blended portfolio of ETFs, mutual funds, etc. So let's assume an average fee is a percent a year. Now, what would happen to those numbers, both the nominal return and a real return, if you had a brokerage fee of 1% per year? Well, it's significant. It reduces everything by 1%, right? So if you have a real return of 7.8% or inflation adjusted, it's now 6.8 or roughly 7% return. Now it's slightly less interesting as it was. Now, what about taxes, right? If you're filing jointly and making more than $97,000, your long-term capital gains rate, and this is if you're filing jointly, right? So you and your spouse are making $97,000, your capital gains rate is 15%. Now, in order to realize any gains, you'd have to sell, right? And those gains would be reduced by 15%. And very few people leave everything in and reinvest all their dividends. Those returns are, by the way, with everything reinvested, nothing ever taken out whatsoever. A lot of times we let the market dictate of what we should sell and buy, and typically we do it at the wrong time. And of course, if our financial advisor or broker doesn't actually sell anything, they don't make any fees either, right? So there's a little bit of a conflict of interest there. But the point is, any gain you have, even if you hold for 20 years, that gain will be reduced by 15%. Now, and so finally, there's a couple of other things that are problematic with the stock market. One is the volatility. Now, in the long run, obviously, it's gone up, like we said here, nominally by 7% after inflation adjusted and the fees. And so in the long run, it's obviously going up. But in the short run, it's not, right? In the short run, it's very volatile. Look at any 5-year chart, you can see it thrashing around, especially when you go in on a one-year chart. Now, this is problematic because sometimes you actually need to liquidate some funds. You maybe want to put the kids through college, so you're trying to sell stuff out at a 529, or you have some medical bills, or you're trying to retire it, so you need to liquidate some stuff. And if the market's down 10, 15, 20%, that's a bad time to sell anything. But now you have to, right? And so this volatility makes financial planning very difficult. It's not just, let me just go 7-8% up and then create my nice little graph. No, it sloshes around wildly, especially in a 5-year term. That can make financial planning very frustrating. Also, it doesn't really generate any kind of meaningful cash flow. Yes, dividends, etc., but unless you're doing some very advanced stock option strategy, it's not kicking off 7 or 8 or 9% cash on cash return unless you put everything in highly dividend producing investments, which no financial advisor would recommend doing that. So your actual cash on cash return is going to be very much lower, to the point where it's not meaningful enough where you can exit whatever you're doing. If you're a W-2 employee or you're a business owner or whatever, you can't really use the stock market to exit. And you have to abide by the 4% rule, which is you can only liquidate 4% of your assets to live off of. Otherwise, you start depleting the principal, right? So if you want to have $80,000 of quote income, you would need a $2 million nest egg that you can sell 4% from. And who has that, right? The average saving rate in America at age 65 is $175,000. So the average American is light years away from having $2 million in the bank. So the stock market it should be a powerful tool in your investing toolbox, absolutely. But there's other alternative investments that get you there much faster, both with a cash on cash return, also an overall return and tax benefits, and that is real estate. Now, the problem with real estate, if you have any kind of rentals or flips, it's not very passive. Even a rental property, if you had one, it's pretty cool for a little while until your tenant stops paying or has to move out, and you look at the place and see how much repairs you have to do. So rentals are not very passive either, and they don't produce a lot of cash flow. If they produce $100 or $200 a month, yay, that's cool. That's not enough to get you out of your six-figure job, right? And so how in the world do you scale passively investing in rental properties? It's not easy to do. In fact, most people kind of give up and kind of throw up their hands and say, hey, something's not right with this real estate thing. The solution is to invest in commercial property, specifically in our world, multifamily, but there's others that you should look into, which is self-storage, mobile home parks, light industrial, that kind of stuff. Commercial real estate. Why? Because the larger these commercial real estate properties are, the less risky they become. They're more stable they are. The more professional the management is, right? If you have a 100 unit and one tenant doesn't pay or move out, well, you still have 99 paying, right? Your break even is, 50 tenants, half the tenants, whatever the case may be. With a single family house, when that person moves out, all the cash flow stops flowing and you're paying 100% of the mortgage. So commercial real estate, multifamily specifically, is much less risky because of that. Number two, the returns are much higher than the average stock market. So in our world, we're doing deals at 17% average annual return, and that's a much, much bigger return, obviously, than the stock market. And that is, of course, before inflation. But what happened last time inflation ran up, and talk about the inflation hedge here, when inflation went up by 9%, okay, this is a perfect example of what I'm talking about, that real assets like real estate are an inflation hedge. When inflation was at 9%, our rents went up by 25% in like over a 12 to 18 month period. And that hugely increased the value of those property. Therefore, it boosted the average annual return much more. So in other words, that inflation adjusted is still around 17%. In actual and nominal growth, it was more like 25% caused by inflation. But the real growth now was still, after inflation adjusted, still 17%. So in other words, if inflation were to go up again, it will increase rents, and with that, the valuation, and with that, the actual real growth. And then thirdly, the cash flow, right? The cash flow typically tends to be much higher. It's between 5 and 8% cash on cash return, and that's a meaningful amount of cash on cash return. And the last is tax benefits, right? Because taxes really eat into your overall returns. And as you may know, with real estate, you get depreciation, which you get on a rental property as well. But with commercial properties, we can actually do what's called a cost segregation and accelerate that depreciation. So instead of it being spread out over whatever 30 years, we get the majority of that in the first several years. And so that really allows you to offset any kind of gains you have from that right against your passive losses. You can offset your passive income from that, and it carries forward as well. Then when you sell, yes, there's a capital gains that you have to then deal with, but there's other strategies you can deploy, such as doing a 1031 exchange, which we also do, which allows you to actually defer taxes indefinitely by continuing these tax strategies that are encouraged by the government, because the government wants investors to invest in real estate. So there's a lot of benefits that you can get by investing in real estate. So I would encourage you to find out more about investing passively in real estate, and we would love to help educate you in that and become your trusted partner. We specialize in operating multifamily properties, and we have about 2,000 units professionally managed, and we have a full-time staff of asset managers, investor relations, construction teams to actually help us not only grow our portfolio and your returns, but also operate those soundly and return the returns we say we're going to return. So check us out. We're at nighthawkequity.com. There's a lot of content on there. If you're new to it, there's a download you can download that introduces you to essentially real estate syndications. What is that? It's like an FAQ document. If you're actively looking for returns, then definitely schedule a call with us, and let's have a conversation about what your goals are and kind of what some opportunities that we have that are coming up. We'd love to have that conversation with you. All right, until then, catch you next time.